Okay, now I was saying that this monthly payment, this annual payment, the interest rate per annum, I need to divide it by 12. In case I maybe take it the way it is, assuming I had the monthly interest here, like I get 15 divided by 12, then there will be no need to divide by 12 at this level. But since it is per annum, I need to divide this by 12. Then I put a comma. Then it is asking for NPER. NPER is the number of periods. And the number of periods in this case, there are 36 because you've borrowed for 3 years. Okay, 3 years. If I look at the number of months that are in 3 years, of course, those are 36. So I click in 36. Then I put a comma. Then it is asking for the present value, the PV, and that is the present value of that is the loan amount. So it is 50 million. Then it is asking for future value. Before that, I need to put a comma. Future value, can put 0 and then put a comma. Okay. Then payment is timed at the beginning of which period? So I can also put 0. Okay. Then I close my bracket. So once I close and I press enter, of course, it is going to bring me my monthly payment. I can expand my cells. Then it brings me my monthly payment. Later on, I will just change the figures to the currency because this is assuming it is Uganda shillings. So I can edit this, can format my figures so that they are in Uganda shillings. So I look for currency, okay? And of course, the symbol is UGX. So I look for UGX, I type U so that it takes me where UGX is, and then I click OK. So that is Uganda shillings, okay? In case you want to remove the decimal points, you want to round off the nearest, you can also remove the decimal points. So that is the monthly payment. So mean that if I've borrowed 50 million at 15% per annum, that means that every month I will be paying 1.73, okay, for 36 months. And remember, this amount includes both the principal and also the interest. Now, I may need to know the total recoveries. Total recoveries. So what would be the total recoveries at the end of the loan period? So the total recoveries at the end of the loan period, okay, at end of loan period. So for me to get the total recoveries, I need to, and of course this total recoveries includes both the principal, the 50 million that you were given, and also the interest. So for me to get the total recoveries, I need to get the monthly payment. So I'll put equal signs. I can put equal signs here, and then I get this, the monthly payment. I multiply this by the loan period. So meaning that at the end of the loan period, if I've borrowed 50 million, I would pay back 62.397 M. Okay, so that is the total recoveries. What about the interest? How do I know the total interest that I've paid? total interest paid. Now, for me to get the total interest, I need to get the total recoveries. So I'll get the total recoveries. I can add the loan amount. Let me add these two together. Okay. So that means that the total interest would be 12 million, the one that I would have paid at the end of the 36 months. You can see it from here. Because if you look at 62 and 50, ideally you realize that the difference is 12 million, meaning that you've added 12.39 million as the interest. Okay. Now, having that framework, I can now prepare my amortization. I can prepare my amortization. Yes, I can see Boaz has raised a hand.
Yes, good morning.
Morning.
Good morning, Sevo.
Yes.
And good morning, colleagues. My question is on the total interest paid. You said it's total recoveries plus the loan amount. I was expecting to see the figure coming to like 112 million, but I'm seeing it's 12.
You said what?
Minus.
You said total interest paid is equal to total recoveries plus the loan amount.
Minus. Minus.
Of course, it would be a minus, but you see, this is already a minus, eh?
Yeah, I get it.
Added the loan amount.
I get it.
If this
Thank you.
was not a negative, then I would subtract. But now, since
I've got it.
So now, my loan amortization now. So I can have my loan amortization. Loan amortization schedule. So I will have periods. So I can have period, then I can have PMT. And of course, PMT, I've said that this is the monthly payment. Okay. And it includes both the principal and the interest. Then I can have the principal payment, can have PPMT. So PPMT, this is the principal payment, and put principal payment. Okay, that is the principal. Then I can have also IPMT. IPMT. So IPMT is the interest payment. Okay, the interest payment per month. Then I have, because this is the monthly, this is the principal, this is the interest, then I can have outstanding balance at the end of the period. So I can have outstanding, so balance outstanding. And of course, this balance outstanding would be inclusive of the interest. Okay, maybe later on I can put something principal balance at the end. Principal balance. Because you may find that at any one time you may want to repay your own. So meaning that you need to know the outstanding principal. But this balance outstanding includes, this one includes interest. Okay. So now, how do I get, of course, the assumption is that the loan is disbursed in period 0 and then payment begins at the end of period 1. So we'll have 0, 36. So once I say 0, 1, then I put 2, then I can be able to drag and reach up to period 36. So I can drag up to period 36. So for you to drag, you need to first select the first 2. In other words, come here, select these 2, then you drag up 36 so that you show the pattern. So meaning that up to period 36 till 36. Okay, that is up to period 36. Now, I need to, in period 0, if the loan has been disbursed, then the bank would expect to recover the entire 62 million. So I can say that now balance outstanding here at the end of period 0, and say equal signs, I click in this total recoveries. So that is what the bank expects to recover. Then I come here, I determine my monthly payment. And of course, the procedure is the same. The way I determine the monthly payment here, it is going to be the same procedure. The only difference is that I need to lock certain cells, certain variables rather, such that my monthly payment is going to be the same right away from period 1 up to period 36. So if I come here, I say equal signs, PMT, and we say that this PMT calculates the payment for a loan based on constant payments and constant interest rate. Then I open the brackets. It is asking for the rate. So the rate is 15%. But remember, this rate is per annum. So I need to divide this rate by 12. Then I put a comma. Then it is asking for NPAR, number of periods. The periods are 36. So I click in 36. Then I put a comma. So I can see Agatha has raised the hand. Any issue? Yes, Agatha? Hey, you unmute and then talk. Yes, Boaz?
Why are we having 12?
Yes, good morning. See what you're typing.
Yes?
Yes.
Agatha, your network is not good.
Yeah, no. I wasn't seeing what you are typing, but I'm seeing it now.
You're seeing what?
For me, what I'm asking, what I'm asking, why are we having 12 and at the same time 36?
Which one?
In the formula.
No,
because
12,
you have said it's.
I have divided.
Yes.
You see this 12. If I can go back.
Yes.
You see the first variable is the rate.
Yes.
And the rate is 15%.
Yes.
But I've said that this 15% is per annum.
Yes.
And remember, I am making a monthly payment.
Yes.
So that's why I have to divide this rate by 12 so that I can get my monthly interest.
I have got it.
So if I click in 15%, but this is per annum, it is not per month.
Yes.
So I will divide this by 12, then I put a comma.
Yes.
Yeah.
I get it now. Thank you.
Okay. Then the next is the NPAR. There are some people who are saying they are not seeing my screen. Is there any person who is not seeing my screen? Any person not seeing my screen? So the NPAR, we say it is number of periods, which is 36. So I click in 36 here. Then I put a comma. Then they're asking for the PV, present value. That is the loan amount, the amount that you're taking now, which is 50 million. Okay. Then I put a comma. Future value, 0. Type, you put a comma, then type 0. No, actually, like the last one, it is timed at the end of period 1. Okay. Zero, end of the period. Payment is timed at the end of the period. Now, actually here, it is also supposed to be 0 because we are timing our payments at the end of the period, not at the beginning. So it should be 0. Because when you put 0, it means that end of the period. Payment is timed at the end of the period. If you put 1, then that means payment is timed at the beginning of the period. So our payments, the timing is at the end of the period. Then I close the bracket. Now, of course, if I press enter, it will give me this amount. But this amount should be the same right away from period 1 up to period 36. So if I press enter, it is going to give me that. Okay. Don't mind about the dollars because I can always format my figures to the appropriate currency. Okay. Now, if I scroll down or I right click like this, you see, it is not going to give me the rest of the figures. Why? Because I have not locked certain variables. So what do I need to do? I need to go back in my formula and lock this rate. I will lock the rate. I will lock the period. I will also lock the loan amount. So all these other variables must be locked so that I have the same amount right away from period 1 up to the last period. So mean that if I come here and I press my cursor there where the rate begins from, and when I'm locking, for me to lock, I will use the dollar sign. If you have your computer, the dollar sign is on top of 4. So mean that I will press shift, dollar sign. I lock that, then I come in between here, shift, lock that cell. Okay. Then the 12, of course, I will not lock that. I come in here. This is the NPER, number of periods. I lock it. Then I also come in between. I lock that. Then the PV is the loan amount. I also lock it. Shift. Okay. Because the purpose of locking is that you want your monthly payment to be the same, right away from period 1 up to the last period. What only varies would be the principal and the interest. Then I also lock this one. So once I lock these cells and I press enter, and then I scroll down, you'll find that my monthly payment is the same right away from period 1 up to period 36. So if I want, I can format these figures. I can format so that I have, if you don't want decimal places, you can say decimal places. You don't need and then you come here on symbol, you look for UGX. If you type U, it will take you to symbols that begin with U. Then you can move down with your arrow keys and you look for UGX. And then you press OK. So that is for the monthly payment. Remember, this monthly payment includes the interest and the principal. So meaning that whatever we're going to determine here on the principal and interest, when I sum up these two, they should always give me my monthly payment. For each of the months, you add the principal plus interest, you should have the monthly payment. And you need to know that, of course, the monthly payment is the same, but when I come to the principal, it is going to be varying from one period to another. So you'll find that you begin by paying a lower principal, okay? And the interest will be higher because the bank has given you the money. They want you to use it. That's why they are recovering a smaller portion. But you find that the interest for it at the beginning, when it is a little bit high, especially at the beginning of the loan period, okay? Then towards the end, you find that the interest really is reducing. And then the principal is increasing. Why? Because banks structure loans in a way that if you take it even for maybe 6 months, if it was for 36, and then you say you want to repay back the entire amount, at least the bank would not lose, would have recovered some good portion of what? Of interest. So let me determine the principal. So what is the principal payment? So for principal, I'll say equal signs. Now, this is the principal payment per month. So type PPMT. Now, what does this one stand for? Returns the payment on the principal for a given investment, which is based on periodic constant payments and constant interest rate. So meaning that if I open the bracket, now it's going to ask me for these variables, the rate. And my rate is 15%. So I click in 15%. But this rate, since it is per annum, I need to divide this rate by 12. If it was monthly, there would be no need to divide by 12. But the fact that it is an annual rate and I'm looking for the monthly payment, I need to divide it by 12. If maybe you are making payments at the end of each year, then there will be no need to divide by 12, because that means you'll be paying at the interest will be annual. But the fact it is annual and I'm paying monthly, so I need to look for the monthly rate. Then I put a comma. Then PER. PER is the period. And this is, of course, my best period is going to be period 1. So I click in 1, A19. Okay? That is, and I want you to know that there is a difference between PER and NPER. PER is the period. That is period 1. You're making the payment at the end of period 1. NPER is the number of periods, the entire loan period. Okay? And also, when we are locking our variables, we shall not lock, when it comes to the principal, we shall not lock this PER. This PER will not be locked because I would want my principal. The principal, of course, varies from one period to another. So I put a comma. Then it is asking for NPER, which is 36. So I click in 36 there. Then I put comma. Then it is asking for PV, the present value of the loan amount, which is 50 million. So I come here, click in 50 million, put a comma, future value 0, comma, then type 0. Then I close the bracket. Now, I'm going to lock the cells now. So as I lock the cells, I'll come and lock this red. I lock it, then I come in here, also lock this. Then I don't lock this period, PER. PER, this one is not locked because my principal is going to vary from one period to another. But for the number of periods, I'm going to lock them. So I lock this, then I also lock this one. Then for this, the present value, the 50 million, I'm also going to lock this. And then also this one, I'm going to lock it. Yes, Boaz, any issue?
Yes, my question is on the point of locking. For example, when you look at the B6, me, I stand to be corrected. I would think B6 is one cell.
No, yeah, it is one cell, B6.
Yes. But when we are locking, you lock B and 6 independently. There I want to understand why we are locking B and 6
because now this is
independently.
B. Where is B? This is B.
Yes.
Okay. I am locking B, which is what?
We are looking at B6, which is 15%. Yes.
Because there are two. There is B, and then there is what? 6.
Yes.
These are two cells.
Okay.
There is B, and then there is 6. So mean that if you lock only B, that means 6 would not have been locked. That's why I have to lock both of them. I lock B and I also lock cell 6.
So you lock a column and a row.
Yes.
Okay. I get it. Thank you.
Because if you don't lock, then you will not be able to get the same the what. So if I press enter, okay, and I scroll down or I double click, it is going to give me the principal for each month. I think you can see the principal. It begins when it is low, goes on increasing. It goes on increasing. Okay, and you for the interest you will see that it begins when it is high, and towards the end of the loan period it will be low. So IPMT, so I say equal signs, and now let me type IPMT. I will format the figures at the end, all of them. IPMT, so I say equal signs, then I put IPMT, then I open the bracket. Of course, this is the interest. The rate, okay, the rate is that is rather 15%. So I come here, I put 15%. I divide this by 12. Okay, then I put a comma. The PER is period 1. Put a comma. NPER is 36. I click in 36. Then I put a comma. PV. The PV is the loan amount. The present value of the loan, 50. Put a comma. Okay. Future value, it is 0. Type 0. Then I close the bracket. Now, let me press enter, and I will not lock the cells. You'll see what will happen. If I press enter, of course, it will give you for the first month. But if you scroll down or right click, it will not, if you've not locked the other variables, which are constant, and that means that you will not be able to get the amount for the remaining periods. So meaning that with this case, I need to go back, okay, and lock the cells. So I lock this, I lock also this, because that is one cell, but I don't lock A19. A19 won't be locked. Then I come, lock this one. Then I also lock here. I lock this. Then I also lock this one. Then I press enter. So now if I scroll down or I right click, you can see the interest for each period. It goes on, it begins when it is high. For it, it goes on when it is reducing, okay? And remember, I told you that if you get the monthly payment, the principal for each month plus the interest for each period, okay, you should get the monthly payment. For example, if I sum up these two, let me sum them up here. Yeah? Or let me put it here so that people don't. If I come and say I'm getting this, I'm adding this one, interest plus principal. You see, I get the same amount. If I scroll down, you'll find that the amount would be the same because the principal plus interest of each month should be the same as the monthly payment that you are making. That's what I wanted you to know. Now, how do I get the balance now outstanding? Because at the end of period 0, the entire amount outstanding is 62. But remember, this includes the interest. Okay, it has the loan amount of 50 plus the interest of 12 million for the entire loan period. So mean that if you make the first monthly payment at the end of period 1, then the balance should change at the end of the period. So mean that if I want to determine my balance outstanding at the end of period 1, I'll come and say equal signs. I get this outstanding balance. I subtract the monthly payment, what you've paid. So if I press enter, okay, that means that if you make a monthly payment, then at the end of period 1, you will have 60 million, 60.664 M as outstanding. So if I scroll down or I double click, it is going to give me the monthly, the balance at the end of each month. But remember, this balance includes what? It includes the interest. So meaning that at the end of period 0, okay, at the end of period 36, the balance would be 0. So I can even format these figures so that they are the same. So I can come here and format this currency, the same format, these cells. Then the symbol is UGX. Then I say, okay. I can even remove the decimal points, assuming I don't want decimal points. I remove the decimal points to 0. This one I can also remove the decimal points. Okay. You can say format cells, decimal points I don't need. So This is my amortization. But somebody would want to know how much is the principal? What would be the principal outstanding at the end of each period? Because you see, this outstanding balance includes interest. But I may want to clear the loan before the maturity period or before the end of the loan period. And meaning that if I come to you, maybe as a loans officer, then you would tell me the principal, and maybe some banks, you find that they have a certain percentage that they will charge you as a penalty, maybe for early redemption. Okay, so how do I get my principal? Who can tell me how to get the principal balance? Now, like here, of course, you've paid, you've made a payment. Remember, you've paid this. This is the principal that you paid. So how do I get my principal? So to get my principal, ideally I would be getting the loan amount, this one. I subtract the principal payment, okay? So mean that I'll come here, I say equal signs. I get this loan amount, 50 million, minus, minus. So that means it's going to be a plus. So I'll say plus this principal payment, okay? Because it is 50 million minus, minus. You know, now the signs will change and it becomes a plus, okay? So that means at the end of the first period, you would have paid that. So if I scroll down, that means I will have what? My principal would be 48, but it is not, you see now it is not giving me the right figure. So if I want it to be the same, of course, that means I need to do for each period. Why? Because the balances vary. In the second period, the amount is different. So how do I get the balance for end of period one? So say equal signs. This plus this. Okay. So how can I get it so that I don't need to do for each month? So that if I do the first month, I should be able to get, the zone works in a bank.
After calculating for the first month, you can use that first month for other months by reducing the PPMT.
I think you should have started the calculation from the column of period 0. That would have had one double click and the figures would be
But period 0.
But you started.
The payment was made at the end of period 1. Because assuming now the principal balance here is 50 million. That is the principal balance. So when you make payment at the end of period 1, so if I say equal signs, this, then of course it would be minus the principal. So plus this.
Plus.
So that gives me 48. So if I scroll
that
down,
was.
If I scroll down, would it give me? Yes. So that means it would give me at the end of period 36. So I can even format also these ones so that it gives me, because you see these are dollars.
The same appearance.
So this is UGX. So this is UGX. I can even remove the decimal points. Okay. So if you want them to appear same, you can format them.
Okay. I think that's perfect.
Okay. So once I have this template, even if another client comes, I don't need to really suffer, because if I change here, now assuming that the loan amount has changed maybe to 45 million, assuming the other variables have remained the same. So you find that the rest will change automatically. I don't need to do what? To repeat the same process. If the interest rate has changed from 15 maybe to 20%, I just change the interest rate. So the rest will change automatically. Okay. If the loan period has changed maybe to 24, I change the loan period. Okay, but of course, after 24 months, then the rest, you'll find that you need to delete all these ones, because the loan period ends on 24. If the loan amount, let's say now has gone to 100 million, you just change only one amount. Okay, so that is what you'd be paying, assuming the period is 24. Now, assuming the period has gone to 60, so that means you'll find that after 24, the balance is not yet paid for it. So if I scroll down up to 60, if I go up to 60, you'll find that now I would have paid to 0. So I need to delete this. So you find that at 60, that's when you'll be able to really pay what? So you can see here, this 0 at the end of, okay? So you can also include borders in case you want to print your schedule so that it looks a little bit organized. So you come and insert borders so that it really looks a little, because when you print it out, you find that. So this is amortization, where you can use your spreadsheets.
Would you kindly share?
Yes.
Would you kindly share this table, save it, and share it with us?
Hello, you're saying?
Would you kindly, after this, save this document and share it with us?
Yes, I will share it with you. So meaning that when you go to the banks, really you should not be cheated. Because me, when I go to the bank, there is no bank that can cheat me. The first thing I will ask you, please tell me what is the interest rate, and is it variable or it is fixed? What about the loan period? Of course, you're the one who gives that to the bank. I want a loan for this period. So meaning that I can be able to compute. When I find a variance, then I should be able to question, how did this come about? Okay. All right. Any issue on loan amortization before we close the topic?
Yeah, thank you, sir. I sorry for getting you back, but I wanted you to clarify on how we calculated that figure, which is in B10, the monthly payment, and then B12.
This one?
I've got, yes.
This B10?
Yes.
Let me repeat it here. I've said to get this figure, okay, the monthly payment, just come, put equal signs, because this is the monthly payment, which is PMT. So type the word PMT, and they will tell you calculate the payment for a loan based on constant payments and constant interest rate. Then open your brackets. Then it is going to ask for the rate. So the rate is 20%. So you put 20%. You divide this by 12 because we are looking for the monthly, and yet the 20% is annual. Okay. Then from there, you put a comma because it's asking for a comma here. And in most cases, you find that people don't differentiate between a comma and a full stop. For example, does put a full stop instead of a comma. Then NPAR is the number of periods. So I come here, I click in the number of periods 60, then I put a comma. Then PV is the present value of the loan amount. I click in this, then I put a comma. Future value 0, then type 0, and then you close. Once you press enter, you would be able to get your figure. If you want, you can even format it to the appropriate currency. If you want UGX, you type U, and then you look for UGX, and then you say, okay. I think you've seen how I've got it. Any other issue?
So the formula is automatic in the Excel?
Yes, it is there in Excel, and it even tells you what you should input. Because if I say equal signs and I say PMT, okay, then I open the bracket. You see, it is asking for the rate here, NPER, PV, then the future value and type. We've said it is 0.
This means that the exam will need the computers.
So for the exam, you may do it manually.
There's a manual way.
Yes, this is what we looked at last week, the manual way. The manual way.
Paolo.
Okay, thank you. I've remembered it. I've remembered. It's okay.
So that marks the end of our second area. So I'm going to share our third topic, that is working capital management. I'm going to share this working document with you. I will send it via emails to Dr. Linus's email, and maybe you can share it with others.
Hello?
Yes, please.
Maybe on the amortization, if you are dealing with salary loans and they are tiered on what one earns, and as per the Bank of Uganda regulation, you are not supposed to take more than 50% of a customer's salary. How
But
can you embed in that formula? Yeah. 70, I think it's going above.
But of course now,
because as
if somebody, assuming somebody was really earning, let's say like 2 million, and he comes to you, that is the take home. Huh? What do you base on? Do you base on the net or you base on the gross? If somebody comes,
based on the net.
You base on the net. Ideally, you would have seen, because if I come to you and I'm earning 2 million, I say I need 100 million, and my net is 2 million. When you look at this percentage, now what percent is this? If I say this equal sign, this divided by 100 times 100%. No.
No, it is the monthly payment divided by the salary. So that you get the percentage of his salary.
Yes.
Divided by the net salary, which is 2 million.
Assuming I'm getting 2 million.
So that is over and above.
So times.
That is like 100 and something percent. Times 100.
That is 132%. So you realize that this person wouldn't qualify.
Yeah.
Unless he has some other source of income. So if I put here, if I put 5 million here, assuming I put 10. I put 10 million. So now you see the percentage here will change. Actually here it should not be Uganda shillings. You can format this so that it reflects general number, no percentage, and even remove the decimal points.
And return the interest rate 15, where it was.
I do what?
Return the interest rate 15, where it was.
15.
Yes.
And the loan period was 36.
Yes.
And the amount was 50. So that means I need to delete the other figures down from 37 onwards. Okay, so that is it for amortization. And that marks the end of so I will send this document so that you can always revisit and see. So let me stop sharing this.
Thank you.
Okay, I can see Innocent putting up the hand.
Master, the students do master's involvement studies and planning and government. Last lecture we didn't complete it because we were heading for another lecture. So we need to complete this amortization manually using the formulas, not using Excel. So I don't know, maybe at some point we shall need to be taken through.
I think I will send you the recording because I was recording that session. I will send you the recording.
Oh, that is very okay then.
Now you said you have we agreed that we should always begin at 8. Since you have a class at your class begins at what time? The second class, the second session. What time does it begin?
It begins at 10.
Yeah, but then let's always ensure that by 8 we are already all of us online, so that by 10 we are done. Because now I see we have less than 25 minutes. Yeah. So let's.
That is
online.
Yeah, you are sir, you are very right. But for today, I think for today we are okay because today the classes are not there. Yeah.
We were here before 8, some of us, me and Ambrose.
Let me share our next
Dr. Joseph Ruhinda. Keep attending very early.
Today you woke up very early. Paul.
So our third area, our third topic is working capital management. I believe all of you have the notes on working capital. This is a very key area because if you find that you, any business, or even you as an individual, you fail to manage your working capital needs, then automatically, however much profitable your business is, okay, you will not be able to survive because you need the funds to run your day-to-day operations. Otherwise, if any business does not have enough working capital, then automatically you will get challenges because you find that every time they are taking you to court. Even when we get our salaries, we must be able to forecast and see how much would maybe how much would you need, okay, to meet your day-to-day obligations up to the next period when you expect to get another what inflow, especially if you find that you are getting money at maybe regular what a defined period. So working capital is a key element, okay? And when we talk of working capital, that is the capital that you need to run your day-to-day operations, okay? How are your current assets, the excess of your current assets over the current liabilities or current obligations? And when we talk of working capital management, we are looking at managing both aspects of all aspects of current assets and current liabilities so that you minimize the risk of insolvency while you maximize return on what? Assets. Because you see, if you find that you have got too much working capital, it is also dangerous. But if it is also low, it is also dangerous. So you must maintain a balance, which in most cases is not always very easy, okay? Because having a balance of your current assets and current liabilities, in some cases, it really requires a lot of work, okay, for you to be able to match the two. So as we are looking at working capital, there are different elements of working capital that we should look at. One of them, of course, is inventory, okay? Because you find that organizations invest a lot of money in inventory. So if it is not well managed, or you find that all the resources have been committed in inventory, it is going to be a little bit costly for the organization. So that is one element. Then we shall also look at management of cash as another working capital item, cash resources, because cash is key. The liquid resources, you need liquid resources to run your operations, but also you must ensure that they are not very high, because if you have too much idle cash, it is also not good for the organization, even you as an individual, because you must really be able to balance and see how much cash do you require, and then any surplus, then it should be invested to generate more returns. Then we shall also look at management of debtors, because you find that organizations sell on credit. Because if you don't sell on credit, there is no way you will be able to survive in this competitive world. Because if I know that you have a very strict credit policy, then I may not come back to you as if I'm a customer. because I would want to go into, I would want to deal with basically suppliers who give credit, okay? But also, as you look at the data, then you should also note, you need to be extra careful so that you should not have a lenient credit policy. Because if you find that your credit policy is too lenient, then maybe your debtors will take advantage. And you know, there's a possibility of losing that money, especially when the debtors fail to pay. Okay, so shall we look at management of debtors as one of the working capital elements. Then also management of trade payables, because the suppliers in most cases advance credit to you. So how are you going to manage them? Do you pay them before you collect money from your debtors? If you're doing that, then that means it is not proper. That means you're financing your payables using resources, okay, generated from other maybe ventures or other sources. So meaning that the idea would have been you collect your money from your debtors and then you pay your suppliers. And maybe you also take advantage of the trade credit that your suppliers give you, because that is one free source of finance, actually, which is interest free. But of course, as you also do that, you need to be extra careful so that you do not damage your reputation with your suppliers, because if your suppliers get to know that you are slow at paying, then that means that any maybe future supplies, they may always give quite high prices because they want to factor in the time period that you take with their money. So you need to ensure that all those are taken into consideration. So investing in working capital, of course, has a cost, which is normally expressed as either the cost of funding it, and then the opportunity cost or lost investment opportunities, because you find that cash is tied up and then it is unavailable for other uses. Now, what are the main objectives of working capital? The main objective is that you want to maintain a balance between current assets and current liabilities. I don't know, when I talk of current assets, especially maybe everyone knows what a current asset is and a current liability is. My friends of MADS and local governance, when we talk of current assets, and especially those of MBA who are from other disciplines, who can tell me what a current asset is and what a current liability is, and giving me examples. Yes, can I have someone to define for me what is a current asset and what is a current liability? I'm waiting.
A current asset, in my view, is any asset either in form of cash or item that can quickly be converted into available liquidity within a short time. That includes like cash at the bank or the payment receivable. For instance, you made a supply and this money is supposed to be coming back to you within a month's time. That is an asset. Liability, current liabilities, in fact, those items that you need to pay for, like you've bought goods and you need to clear them, you have salaries to pay for your staff, those are current liabilities.
Yes. In other words, current assets, they are short-term in nature. And they are used within one accounting period. Okay? Like as you said, cash at bank, cash at hand, stock, any prepayments made. So those are current assets. Current liabilities, obligations which are short term. You find that the month has ended, you have to pay salaries. That is a current liability. You have to pay power bills. You have to pay water bills. All those are current what? Liabilities. In other words, obligations that are short term. Okay? Those are current liabilities. But if you find that it goes beyond 12 months, then it is no longer current, but becomes what? In other words, you enter into and you have an obligation which is for 3 years. That is not a current liability, but it is a long-term liability. So one of the objectives of working capital management is that you want to ensure that there is a match between these two. Your current assets are matching current liabilities, but which in most cases is a little bit hard. You see, saying it might be easier, but now I give you to draw an individual balance sheet. When you look at your assets and your liabilities, is there any match? Huh? Let me ask Samson Edodi. When you balance, assuming you have to draw your balance sheet now, you want to compare your assets and liabilities. Is there a match between the two, or there is a mismatch? Yes?
Yes, there is, I think there is a mismatch since the assets that we can convert into cash immediately, and those ones obligations that we are expected to pay. So when you convert assets and liability, most times I have mismatch. We have mismatch, in my opinion, anyway.
No, I mean in your when you add your assets, your current,
yes,
and you look at your current assets, the ones that you have, and
I have my assets. My assets are more than my liabilities.
Your assets are more than liabilities. Then that's
yes,
that's very good. But also,
then you are
you find that you have more assets.
Is here Ugandan?
If the assets are idle, it is also not good. It depends on the assets. What are they generating? You know, there are some people who will sit there and say, "Me, I don't want debt. I don't want to go into any debt." Yeah, there are people who are risk averse. You are risk averse. You say, "I don't want any debt. Let me use what I only earn." You say, "Go and borrow." No. Let me give you on credit. No. I don't want credit. I want to use my own resources. Those are risk averse managers. Somebody had an issue? So we are saying that mismanagement of working capital is a common cause of business failure. And this is very, very key. you fail to manage your working capital, then automatically, however much the business is profitable, you can't survive. Because that means that you will fail to pay your bills. Then you find that there is overtrading during periods of growth, or you are overstocking than what you need. So that is dangerous. You find that you cannot pay employees' salaries at the end of the period. So that means there is a mismanagement. Okay? There is a mismanagement because you have failed to balance your working capital needs. Then another objective of working capital. Yes.
What do you mean when you say overtrading during periods of growth?
When I talk of overtrading, you are over expanding than what maybe the current you are over expanding than the current market needs. You have seen such kind of companies whereby somebody is over expanding, and you're expanding not using even your own resources, but you're using what? Borrowed funds. You are venturing into many things at the same what? At the same time. That is what we call over trading.
Okay, thanks.
You undertake more activities than really what is needed. So another objective, yes?
I'm inquiring, sir.
Yes?
What's wrong with overstocking yet your products are moving? If the products in the long run are moving, they're not staying in stock.
You see, how do you know that they will be moving? If they are moving, that is okay. Because that is not overstocking. If the products are moving, that is okay. It is not overstocking. That means that whatever you bring, it goes. But when I talk of overstocking, it means that you are bringing on board, you are buying stock than the available demand. So you have too much stock in your stores. And you know the dangers of that. Some stock will become obsolete. In fact, even when people get to know that there is too much stock, your workers will even steal. Every end of day, you find somebody's taking some, especially if it is like hardware. Because you find that the employee will take one item, and you know some of those items, they are of high value. Somebody will take an item very small, but you find that it costs 100,000. So if every day I'm taking that item, what will happen? Every day you are losing 100. So overstocking is dangerous. But when the goods are moving, then that is not overstocking. Then that means that you are forecasting what you need vis-a-vis what your customers require. Okay? Yes, Isaac Ijuka.
Yes, good morning, sir.
Yes, morning.
I wanted to contribute on the part of overstocking and say, or if the goods are moving. I work in a hospital, and when the goods are moving, most are moving on credit. And I remember you said how you handle your creditors also. Your debtors,
yes,
matters. Yeah, it matters. So sometimes they tell you, please wait, you've already given a service to them, but still you don't want to lose them as your clients too, because you're doing a lot of credit. But it also affects your working capital greatly, and striking a balance becomes a big question to us in the medical field, especially the hospitals.
Yeah, true. Because actually, what happens is that you may find that you are saying your goods are moving, but you are even selling on credit. So they are moving, but remember you are tying up money now in debtors. You are tying up money in debtors, and in the end you will have challenges. I think you have seen businesses, big businesses here in the town collapse, having issues, banks coming and closing, and some businesses that you think really, maybe you think that now these ones have reached at another level, but you reach a time and you find somebody is, haven't you seen in town? Yes, Paul.
Yes, sir. I wanted to ask, is there a standard ratio of this working capital that you should maintain?
Now it should be 50-50. The ideal should be 50-50.
Okay.
But
so as a financial manager, I should monitor and say my working capital is 50% of the total cash I have, and the rest I can maybe invest it in something else.
Actually, even 50-50, would you be in a good position? Because that is, yeah, we can say 50-50. What do you say about 50-50? Would it be
I think
ideal?
it is wise enough. It is ideal.
Yes,
because when you look at time value for money, also you want to have that that cash doing something that brings returns. So sometimes 50-50, I think, is a good idea.
But of course, you know, attaining it sometimes
as long as it's
attaining, attaining is
practically attaining is very hard. Because now, like those of you who are salaried employees, if somebody asks you now your salary that is coming for July, if you are you find that it is not there, it is already gone. In fact, you have even incurred more liabilities. So it is a little bit. Then also another objective of working capital management. Of course, if working capital is managed effectively and efficiently, okay, it is very essential to in maintaining control of business cash flow. Okay, so management has full awareness of profitability versus liquidity trade-off, because this is key. You must, yes, undertake ventures which are profitable, but bearing in mind the liquidity, that you must maintain sufficient cash resources to meet your obligations. And of course, there are some organizations that require to high working capital funds. Because like if it is a bank, much as you get that money and you want to invest it and generate a return, then you must bear in mind that at least you need to maintain sufficient cash reserves to meet the day-to-day needs. Otherwise, if a customer comes and you find that you have insufficient funds, then that means that you'll have issues. Okay, that's why you find that if you got
excuse me, sir.
Yes.
We have a banker here, and maybe he can let us know on the ratio the banks maintain. I'm sure banks have a ratio they maintain of liquidity versus loans, of savings, because if a bank lends out all the money it has, now when a customer who wants to withdraw $1 billion all of a sudden comes, how will they serve him? We have a banker here called DIFAS. I don't know whether it could be knowing.
Yes, DIFAS. Can you share with us your experience? Differs. Is he online?
Let me get him clearly well. He says if someone wants to withdraw 1 billion. Continue. Hello.
All right, if I come to Stanbic and I say I want
Differs, my
Yes,
question
I'm
was,
actually speaking.
my question was, Differs, is there a ratio that you guys as a bank have to
Hello?
maintain between, is there a ratio that you're supposed to
I'm
maintain?
speaking.
You're speaking, eh? Differs. Let me type the question.
Hello, I seem not to get you well. The network is not stable. Yes, yes.
Let me type the question first. Can you hear me?
Maybe if I can answer you well, we normally have limits.
Your network is not good.
If I can say something.
Yes.
Yes, I know that the central bank, for example, determines the minimum a bank should have. And if the bank is not able to meet up, they can match the bank with another bank. And we have gone to a particular bank branch to withdraw some amount of money, and the money was matched. So the branch say, they refer us to a different branch to withdraw the money. So I believe they have a benchmark that they want to maintain to do their transactions. And if you want to withdraw billions, and if they see that they give you the billion, their account will be red. And other customers that need little changes, they will not be able to service them at that time. They will refer you to a different bank or different branch. I think that is what they do.
Yeah, true. Because if you go in a bank and you need big sums of money, billions, if the branch cannot handle, they will tell you, please wait a minute. Either you can maybe give us some time, but they may not give you, they may not be able to serve you at that particular moment. Actually, I already see some of these agency banking or these mobile money operators. You find somebody, you're operating on 1 million. Then a customer for 1 million comes and you want to serve the person. So that means that you will be out of business. If you're operating on working capital of 1 million, and then I come, I need 1 million, you give it to me. That means that yes, you will have the fraud, but you will not have the cash to serve other customers. It is going to affect your operations. That means before you go and liquidate your fraud, that means the entire day you will stay there without working. So somebody who has balanced and you check the customers that you can serve, depending on what you have, then I think you would be in a better position. Because somebody who has served customers who have been withdrawing maybe 30, 20, several customers, is in a better position. One, he's going to maintain his customer base. And secondly, the money, the commission that he earns is going to be much more higher than one who has served one customer. And then you find that you run out of cash to use. So this is very key. Forecasting what our requirements, what do we need? And of course, how are we going to finance our needs is very, very, very important. Because as I said from the beginning, even if your business has got, makes profits, you find that your business, you have all the assets, but you don't have enough working capital, okay, needs, then it is going to be really it's going to be dangerous on your operations. Because it will affect your operations. You'll find that you cannot be able to finance your working capital requirements. Then also
going back to the example of the bank where Paul was bringing in the case of a client who comes and needs 1 billion. How many times do you go to the bank and you want a loan, and the same day you've gone, the loan is advanced to you? It's a process. So by the time you finish filling the documentation, signing and doing all those things, really the bank will have known whether they're in position to meet that loan requirement or not. So basically, if giving you that loan, the 1 billion gives them good interest, I believe they will do everything, if it takes a week or two, to avail you that money, so that by the time you need the money and the process of requesting for that loan is done, the money will be available. So, but of course, I also agree with the fact that there should be the checks, the limits. I saw DFAS mentioned something, they have limits, daily limits, in a way to make sure there are some reserves maintained, just in case. So basically, I think they are also practicing this working capital management quite well.
Yeah,
Yes,
actually,
what I
that's why
pick from DFAS, what I am picking from DFAS is, as a branch manager, you are supposed to do an analysis of the withdrawing patterns of your customers, you know, so that you have those, so that you maintain a certain amount of cash that can satisfy that pattern you've studied over a period of time, or maybe over like a year, I think, or 6 months, I don't know. Over the previous year, they study the pattern of withdrawing money, how people withdraw, how they deposit, so that you maintain a certain limit of money at the bank. Because, you know, banks are lending out my savings. I have saved my 1 billion on the account. The bank will get it and lend it to somebody. But then all of a sudden, maybe something can happen to me and I need my 1 billion. At 1 p.m., I go to the bank and the bank is telling me, you know what, first wait, let us first call. So as a bank, they sort of do an analysis. I think this is what I'm understanding. As a business, you need to do an analysis of how, now like the case of the hospital Isaac gave us, you have to do an analysis of how do people consume our drugs, so that it advises you on how much stock of drugs you should maintain. Then how do my creditors tend to demand their money? This one demands immediately, he supplies, or this one can give me a month, so that you do an analysis and say, okay, I will have so much liquidity on my account. Then the rest, I can maybe build a ward for children. So you have to do an analysis. This is what I'm understanding. We might not necessarily say the ratio is 50-50. It seems the ratio varies depending on the business and depending on the analysis you have done.
Depending on the analysis, what you've done, okay? Because actually that's why you find that for these big borrowers, you find that banks engage in loan syndication. You find that one bank may not be able to advance the loan. So in other words, what do? They arrange with another bank. You have seen like this DTB case that is always in the news. Because you find that you are not able to provide that amount. Because if you provide, then it will affect your working capital. So what do? You arrange with another bank and you ensure that you do what? You meet the client needs. Then also another objective is necessary to maintain liquidity. This one we have already talked about it. I will not very much on it because you need the liquid resources to meet your obligations when they fall due. Then maintaining a steady sales activity through a steady operating cycle. because you know that some current assets are needed because sales do not convert into cash immediately or instantaneously. You may not get the money immediately. You may find that you've sold, yes, but it takes quite some time for you to receive that money. What are the dangers when you find that your working capital is too much? Because it is dangerous, it's also not good. Too much working capital is bad. Also, if it is inadequate, it is also not good. That's why we are saying that you need to strike a balance. Number one, if it is too much, you will have so much of inventory. And you know, if the inventory is high, then their costs is going to be wasted. People will steal, you will incur losses. To be mishandled, it may become obsolete. So too much working capital results in unnecessary accumulation of inventories, and there are costs associated with that. Then it may also be an indicator of a defective credit policy, especially if you find that you have got so many debtors, or what you sell, but you sell on credit. So you have so many debtors, and of course, this is basically dangerous because there is a possibility that those debtors may fail to clear their obligations. Okay, and this may affect profits. And of course, management also becomes complacent. And in other words, it results into inefficiency. Okay. But also, if it is inadequate, it is also a little bit, it is not good. Because you find that growth will be at a standstill. Because it will be hard for you to undertake profitable projects. Okay. Especially if you do not have enough working capital funds. It becomes difficult to implement operating plans. And then the firm might fail to achieve its targeted profit. Operating inefficiencies, especially if you fail to meet your day-to-day commitments. Firm's profitability deteriorates because you find that the fixed assets are not efficiently utilized due to lack of working capital funds, and also the firm loses its reputation. Okay, especially when you are not in a position to honor your short-term obligations. That's why I say that you find that any future supplies, your customers will quote high prices because they know you take either long to pay, or you are very bad at paying. Now, of course, given the above dangers of excessive and inadequate working capital, management of an organization needs to maintain the right amount of working capital on a continuous basis so that you ensure there is proper functioning of business operations. Then management should also use sound financial and statistical techniques, normally supported by individual judgment. That is what the banker was saying. You need to make a judgment so that you see the patterns of your customers, so that you can be able to predict the amount of working capital needed at different time periods. Because you see, the periods vary. There is when we have peak, you are in peak period, like Christmas. You know that people would need, if it is a bank, people would need much more money. Okay, even when you have maybe hardware, maybe people would require more items because you find that maybe they want to complete their projects so that by Christmas, they are ready. Okay. So the peak, you need to consider the time period because the periods vary. There are times when you find that the demand is too high. So you should be able to analyze, predict, and ensure that you are able to meet your working capital, finance your working capital requirements. So I want to stop here for now because I have a meeting at, actually it has started. So when we meet, we shall start from there next time, unless there is an issue for now. So any issue? Paul, I can see Paul putting up the hand.
Oh, sorry. I don't think I didn't put it down. Let me put it down.
No online things, people. Okay. So if there is no issue, then we meet next Saturday. But as we have agreed, please, let's always meet at 8 so that those people who have a class at 10, they are able to go for their class. Because now from 8, you can meet up to 10, and then we give room for the other group to attend their lecture. Okay? Otherwise, see you next time. Bye for now. I'm going to send the other template for amortization right now. I'm going to send it to the email so that you can share it and use it.
Maybe before you go, how can we get the
use the I wish you can use the students to all of us at the same time.
The what? Hello?
I was asking how we can get the recordings.
The recordings. The recordings, you see, I am going to, have you enrolled? Anyway, I have not set up the course, but I will set it up and then you can enroll. Then that's when I will be